Japan's economic system is the most indebted on the planet and is on the verge of collapse. And the next impact could even bring down the United States. Japan's public debt has already surpassed $8 trillion. They owe the equivalent of 260% of their own GDP. It has the highest level of debt among all developed. And now, long-term bond yields are soaring as if the entire market were silently screaming, "This can't be sustained anymore." A clear sign that something serious is beginning to break down from within. This is not a theory. It's a real proven movement with effects already visible in global markets. While the world pretends everything is fine, the Japanese debt bomb is about to explode and take entire economies with it. By the end of this video, you'll clearly see what almost no one has noticed. Japan is the silent trigger of a global financial crisis. And if you understand this now, you may be among the few who will protect themselves and even profit from what's coming. The trigger warning. Japanese interest rates soar for decades. Japan was synonymous with stability, but that's over. When the interest rate on the 40-year bond exceeded 3.7%, alarm bells started ringing. This number may seem technical, but it carries a clear message. Investors no longer trust Japanese debt. High interest rates on long-term bonds mean that risk is increasing, and rapidly. For the first time in generations, Japan is being treated as a risky bet. And this is much more serious than it seems, because when the most indebted country in the world loses the confidence of the market, a domino effect is inevitable. This is where the tide begins to turn, and few are prepared. Until recently, Japan paid almost nothing to finance itself. Even with the gigantic debt, the interest rates were practically zero, sometimes even negative, but that cycle reversed, and quickly. Investors are demanding higher premiums to keep their assets locked in Japanese bonds for decades. The reason? The fear that the government will no longer be able to roll over its debt without printing money. This is the type of situation that precedes ruptures. The perception is shifting from as safe as Japan to a ticking time bomb about to explode. And the numbers show that the fuse is already burning. What few people have understood is what this movement represents in the global game. If Japan, with its tradition of discipline and stability, has lost control, who is truly safe? The market doesn't react to headlines. It reacts to flow, and the flow is fleeing. Large funds, central banks, and institutional investors are quietly reviewing their positions. There is no visible panic, but there is movement behind the scenes. And that's always the first sign that something bigger is coming, because capital never gives any warning when it's leaving. It simply goes, and when it becomes visible, it will already be too late. This increase in interest rates is the first visible crack in the hull of a giant ship. And it's not just any ship. It's the third largest economy on the planet. If Japan loses control of its debt, the impact will not be local. It will be global. The repercussions of this directly affect Wall Street, the dollar, and U.S. Treasuries. Because in the financial world, everything is connected. An earthquake in Tokyo could cause a tsunami in New York, and the markets are already starting to prepare for that. You should do the same. And there's a detail that most analysts ignore. The surge in long-term interest rates is not just a response to Japan, but a chain reaction to changes in global cycles. The world has moved from a cycle of cheap money to an environment of monetary scarcity. And Japan, which survived for decades with zero interest rates, now has to pay a high price to maintain confidence. This change destroys the logic that has sustained the country for so long. It's like taking away a planet's gravity. Everything starts to float, to lose its shape, to get out of control. And this lack of control, when it happens with a debt of $8 trillion, is explosive. Don't be fooled that the 3.7% interest rate is not just a number. It's a silent pronouncement on what the market sees for Japan. It's like a thermometer registering a high fever in a patient who had long seemed stable. The question now is no longer whether there will be consequences, but when and where they will explode first. Because this increase in long-term interest rates combined with the monstrous debt and economic stagnation, it is what opens the hole into which empires sink. And Japan is dangerously close to the edge. But nobody wants to be the first to say it out loud. That's why the movement remains discreet. But the data doesn't lie. The Japanese yield curve is distorted. The premiums demanded by investors are rising across all maturities. And this distortion is precisely what precedes a collapse in the trust system. Trust is what holds everything together. When it breaks, financial gravity disappears. And with it, certainties, prices, profits, and stability disappear. This is when bonds cease to be safe assets and become dynamite, and Japan is holding the lit fuse. And that brings us to the next point. Japan is not just heavily indebted. It is dependent on constant debt rollovers. The risk lies not only in the size of the debt, but also in its maturity date. Because if the country needs to issue new bonds all the time to pay off the old ones, any increase in interest rates will destroy the public budget. This is the definition of a time bomb, and it has its timer running. In the next section, you'll understand how this reliance on rollover is at the heart of the crisis. And why is this structure doomed to break down, with or without warning? The debt bomb. 260% of GDP and endless debt rollover. Japan is the most indebted country among developed economies, and that's not a metaphor. Japan's public debt already represents about 260% of GDP. In other words, for every dollar that Japan produces, it owes $2.60. It's as if a family earned $5,000 a month but owed $13,000. But this debt isn't frozen. It needs to be renewed all the time. Rolling around became an addiction. And like any addiction, there comes a point when the body can't take it anymore. The detail that almost no one notices is Japanese debt is not only large, it is fragile. And all it takes is a change in the wind for interest rates to bring everything crashing down. The logic that has sustained Japan until now is simple but dangerous. When the bonds mature, the government issues new ones to pay off the old ones. This cycle only works as long as interest rates are low. But now, with premiums rising, each debt renewal costs more. The public budget is starting to be drained by its own interest payments. Japan already spends more than a fifth of its revenue on interest payments alone. And this is just the beginning, because this spiral tends to accelerate. The more the market demands, the more Japan has to pay, and the more fragile it appears. Imagine this. You take out a loan with a low interest rate, renew it every year, and keep putting it off. Suddenly, the bank says, now the rate has gone up, you're going to pay double. This is Japan today, a compulsive spender in a world that has become more expensive. And we're not talking about billions, we're talking about trillions of dollars. No GDP in the world could sustain this pressure for very long. If the average interest rate on debt rises from 1.2 to 2.5%, the cost explodes by hundreds of billions per year. And the government has no way to cut this spending, because without paying the debt, everything collapses. And you know what's most dangerous? The fact that this has seemed normal for so long. Most analysts simply accept that Japan works this way. But this view ignores the crucial point. Japan only functions this way as long as the market allows it. When trust runs out, creditors demand more. And when Japan can no longer pay, the whole system collapses. Because it's not just about Japan, it's about what Japan represents to the world. A collapse on this scale rearranges global flows, destroys portfolios, and generates a wave of panic. Another overlooked point, more than 50% of Japanese debt matures in less than 7 years. In other words, it's short-term debt, stacked up like playing cards. Any instability can bring everything down quickly. It's a castle of paper that requires constant printing to stay standing. And when investors start to doubt the next issuance, no central bank can stop it. The rolling becomes a race against time. And time is running out in Japan. Up until now, what has kept the system afloat is the Bank of Japan, who bought most of the issued securities, even if it was with printed money. But this also has a limit, because printing too much money destroys the currency. And that is precisely the Japanese dilemma today. Roll over the debt and destroy the yen, or preserve the currency and collapse the system. There is no easy way out, only difficult decisions with global consequences. This bomb, worth 260% of GDP, is the type of structure that it doesn't crumble slowly, it implodes all at once. Because when creditors lose confidence, everything becomes a matter of mathematics, and mathematics has no compassion. Now the market is starting to test the limits of Japan, and Japan is starting to fail this test. In the next segment, we'll delve into this dilemma in more depth. You'll understand why Japan is trapped in the interest rate trap, and why any move could trigger the next phase of the crisis, the interest rate trap. Any decision now carries the cost of collapse. Japan is trapped in a trap of its own making. If you try to raise interest rates to curb inflation, the cost of public debt will explode. If interest rates remain low, the yen weakens, and import inflation tightens, and the purchasing power of the population silently collapses. No matter which path is chosen, they all lead to a painful outcome. This is what economists call the monetary policy dilemma. But in this case, it's not a technical dilemma. It's a choice between two types of bankruptcy. The logic of the trap is cruel. Today, for every percentage point that interest rates rise, the Japanese public sector spends hundreds of billions more just to keep the debt running. It's as if the government had taken out an endless loan, and now the bank has decided to readjust everything. This increasing cost is stealing funding from any other public expenditure. Health, education, infrastructure, everything is starting to get squeezed. Debt becomes the center of the state apparatus. And when that happens, the entire system folds around it. But keeping interest rates artificially low is no less dangerous, because this destroys the value of the yen, and this destruction has already begun. The Japanese currency has been depreciating rapidly. This makes everything that is imported more expensive. Energy, food, technology. Inflation is starting to creep in through the back door. Even though the headlines say she is moderate, the real cost of living for the average Japanese person is rising month after month. This may seem small, but it's not. This process erodes the middle class, squeezes retirees, and stifles local businesses. It's a silent attack on domestic consumption, and that kills growth. Japan begins to live under an illusion of stability, but behind the numbers, the system is imploding from within. And what's worse, the longer the Bank of Japan holds down interest rates, but it also undermines the credibility of the financial system itself, because the world knows maintaining artificially low interest rates with debt at this level is not sustainable. And when trust breaks down, the markets don't forgive. Trust is everything. If investors believe that Japan has lost control of its monetary policy, they demand a higher premium to lend. And even without the government's intention, interest rates rise due to market forces. This is the real trap. Even if the central bank tries to hold the base rate, long-term bonds will respond to the perception of risk. And that's exactly what we saw with the 40-year interest rate hitting 3.7%. The market is raising interest rates on its own. In this scenario, the only tool Japan still has at its disposal is printing money. But excessive printing destroys the money supply and accelerates capital flight. And with escape comes collapse. After all, why hold capital in yen if it loses value every day? The answer is simple. Nobody wants it. And when capital starts to leave, domestic assets collapse. What was once an interest rate trap has turned into a currency crisis, and Japan is dangerously close to that point. All indicators are tense. Inflation is contained only by the artificial control of the system. But this control has a time limit. It has a limit. And when the limit is broken, there is no longer a choice of path. The country is simply being dragged down by the collapse of its own structure. And this is where many people will realize, too late, the problem was never just the size of the debt. It was the inability to deal with it without destroying the system. And now, every decision has the cost of collapse. Either you sacrifice the currency, or you sacrifice the public budget. And when the currency and the budget are compromised, there's nothing to support trust. In the next segment, you'll understand why Japan managed to push through this crisis for decades, and what has changed now, making collapse inevitable. What sustained Japan for decades? Negative interest rates and unlimited printing. For more than 30 years, Japan has defied economic logic. Even with a gigantic public debt, low inflation, and anemic growth, the country seemed too stable to collapse. The explanation lay in a single cog, the Bank of Japan. With an extremely aggressive monetary policy, he kept interest rates at negative levels for almost a decade, and bought trillions in government bonds to keep the system breathing. This was the type of anesthesia that prevented the patient from feeling pain. But anesthesia doesn't cure infection. The Bank of Japan created a model of perpetual stimulus. When the market showed signs of weakness, he bought more bonds. When inflation subsided, he injected liquidity. When interest rates threatened to rise, he would intervene. It reached the point where it owned more than 50% of all publicly issued debt. In other words, the government issues the bonds, and the central bank itself buys them. It's as if the state were financing itself, with new money created out of thin air. This process became known as infinite QE, quantitative easing without end, and it worked until it stopped working. Printing money kept interest rates down, but it also destroyed the value of the yen. Liquidity kept assets inflated, but did not generate real growth. And every time the market threatened to react, the Bank of Japan doubled down. The illusion of stability was fueled by unprecedented artificial manipulation. But all manipulation has a cost, and that cost is now charging interest. The policy of negative interest rates also had profound side effects. It discouraged saving, destroyed bank profitability, and sank pension funds. The average Japanese investor has started to flee from fixed income and seek alternatives outside the country. This is how the yen carry trade was born, something we will explore in the next section. But the point here is, when trying to keep the system breathing artificially, the Bank of Japan created a monster, an entire system that only works while the anesthesia is active, and then the anesthesia started to fail. Since the United States and Europe started raising interest rates, Japan became isolated in its policy of easy money. Global capital recognized this distortion and began to move. Pressure on the yen increased, and the Bank of Japan had to intervene more aggressively. But with each new intervention, the market demands more. It's a vicious cycle, and the more the bank tries to control, the more artificial everything seems. Confidence in the Bank of Japan has begun to crack. Investors began to wonder, how long can they hold this up? And the answer is, not really. Because printing money forever doesn't create real wealth. It creates bubbles, it creates distortions, it creates false senses of security. But when the tide goes out, everyone sees who is swimming naked. And Japan is naked, covered only by manipulated statistics and fictitious interest rates. The truth is that Japan hasn't solved its problem. He simply bought time. It stretched the rope longer than other countries managed to. But the rope is not infinite, and now it's starting to break at its weakest points. The Japanese central bank's policy is cornered, and the system that seemed safe for so long, it is entering a phase where nothing can prevent collapse. And this collapse isn't just domestic, because Japan, by keeping interest rates artificially low for decades, he became the biggest financier of the silent world. In the next segment, we'll talk about that. Yen carry trade, and why this strategy is reversing. This could trigger a global asset market downturn. Demographics, the invisible collapse that no one can stop. Japan is aging faster than any other country on the planet. Today, more than 29% of the population is over 65 years old. The birth rate has been declining for decades. The workforce shrinks year after year. And this is the kind of collapse that doesn't appear suddenly, but never stops growing. It's a demographic collapse, and it's irreversible. This is not a prediction. This is a process already underway. And this process is crushing the Japanese economy from within. Fewer young people means fewer workers, less consumption, and less tax revenue. More elderly people means more retirements, higher healthcare costs, and greater dependence on the state. The numbers simply don't add up. Even worse, with each passing year, the ratio between taxpayers and dependents worsens. Today, for every 100 people of working age, Japan has almost 50 elderly people. Soon, this relationship will be one-on-one. This means that half the population will depend on the labor of the other half. This structure is unsustainable in any system. And there is no amount of monetary stimulus that can fix that. Printing money won't solve the problem of raising young people. Lowering interest rates is pointless if there's no one to consume. Demographic collapse is the silent, long-term break. It slows everything down. Growth, productivity, innovation. Companies are closing due to a lack of successors. Schools are emptying out. Entire neighborhoods disappear. And the government is trying to plug the hole with more debt. But the tax base is disappearing. Public social security has become a ticking time bomb. Life expectancy in Japan is one of the highest in the world, which means that the cost per retiree is also higher. But the number of taxpayers is falling year after year. This forces the state to cover the deficit by issuing more debt. In other words, the demographic problem fuels the fiscal time bomb. And what seemed to be a matter of public policy, in fact, it is one of the hidden drivers of the impending financial collapse. And here's the detail that almost nobody notices. The older Japan gets, the more dependent it becomes on low interest rates. The older population depends on stability. It depends on assets that don't fluctuate. It depends on a predictable cost of living. But with the yen weak and imported inflation rising, this stability is disappearing, along with trust. This creates a brutal paradox. Japanese retirees have billions invested in fixed income. But now these bonds no longer buy what they used to. Income is eroded by inflation. And when the government tries to adjust monetary policy, it directly affects the elderly, the country's main political group. That's why Japan can't escape the trap. Any move against inflation also affects their most vulnerable voters. The solution that many countries would use, immigration, it is limited in Japan for cultural and political reasons. Society is homogeneous, closed, and resistant to structural change, and this makes demographic collapse, in fact, inevitable. The base of the pyramid shrinks, the top expands, and the entire financial structure was built on a model that no longer exists. We are seeing a country trying to maintain a 20th century system with a 21st century population. And although this may seem like a problem unique to Japan, the effect doesn't stop there. Because while Japan was aging, it was also fueling global markets. And much of that was done through the famous yen carry trade. In the next section, you will see how this hidden model of external financing works. It could be the next domino to fall, and why it has the potential to generate a new global crisis. The global link. Yen carry trade in the invisible gears of the next crisis. For decades, Japan has sustained not only its own economy, but also a large part of the global financial system. And this happened through a little discussed but extremely powerful mechanism, carry trade yuan. Basically, investors were taking out loans in Japan where interest rates were almost zero, and invested that money in more profitable assets abroad. It was cheap money flowing out of Tokyo and irrigating the world. But that source is about to dry up, and the impact will be brutal. It works like this. Imagine you can borrow money in Japan paying 0.5% per year. You take this money to the United States, Brazil, or Europe, invests in assets that yield 5, 7, or even 10%, and pockets the difference. This worked for years, fueling stock markets, bonds, and even the real estate market in various parts of the world. The problem? This model only works as long as interest rates in Japan remain low, and the yen remains weak. If that changes, everything falls apart. And what nobody wants to admit is that this has already begun to change. With Japanese interest rates rising and the yen appreciating temporarily in response to shocks, investors who use this strategy are being forced to unwind their positions. It's a silent domino effect. They need to sell assets abroad, repatriate capital, and close leveraged positions. And this movement drives down the prices of these assets, even if the problem is not local. That's why, when Japan changes, the world feels it. And the volume involved here is gigantic. It is estimated that the yen carry trade has moved trillions of dollars over the past few decades. It's like a liquidity pump that's been switched on for 20 years, and now the button is being turned off. Worse still, the market isn't ready for this, because the effect of carry trade has always been silent on the outbound journey. But on the way back, he tends to be destructive. This is what we saw in crises like those of 2008, 2015, and 2020. When a carry trade is unwound, the assets that have appreciated the most are affected. They are the first to fall. Capital is leaving aggressively, creating shockwaves in emerging markets. Technology stocks, high-yield bonds, and even cryptocurrencies. Anything that depends on cheap liquidity goes into panic mode. And this time, with Japan losing control of its own monetary policy, it's not just a dismantling, it's a systemic collapse in slow motion. Another crucial point, Japan is not only a source of capital via carry trade. Japanese banks, insurance companies, and pension funds are major buyers of global assets. U.S. Treasury bonds, European company stocks, infrastructure in Asia. Japanese money is everywhere. And if that capital starts returning home, we're not just talking about falling prices, but rather a structural repricing of the markets. This may sound technical, but it's simple. If the world's largest financiers stop financing, assets need to fall in price to attract other buyers. And this new price level will be lower, more unstable, and more volatile. What seems like an adjustment today could be the beginning of a long downturn. And all of this was triggered by a silent movement coming from Japan. In the next section, you will understand why this side effect occurs. It will hit the United States hard, and how the Japanese collapse could accelerate the crisis of American treasuries. And with it, push the world toward the next global financial shock. Domino effect. The impact on the US and global pollution. When Japan begins to dismantle the carry trade and repatriate capital, the first to feel the impact are the United States. For a simple yet powerful reason, Japan is one of the largest financiers of American debt. Japanese banks, insurance companies, and funds buy trillions in treasuries, US government bonds. And they do this because, for decades, profitability in Japan was zero. Now, with interest rates rising at home, the capital is starting to come back. And when the biggest buyer of an asset stops buying, the price falls. Interest rates rise. The U.S. Treasury is already under pressure. The United States debt has surpassed $38 trillion. And the interest paid on that debt already exceeds $1 trillion per year. If Japan stops buying, or worse, starts selling, the United States will have to pay more to finance itself. And this increase in interest rates affects everything. Mortgages, private credit, financing, investments. The cost of money is rising, and the engine of consumption is slowing down. This is the type of movement that causes stock markets to crash and economies to freeze, and it doesn't stop there. When treasuries become riskier, investors demand a premium worldwide. Brazil, Mexico, South Africa, Europe, no one escapes, because the market is interconnected. If U.S. interest rates rise, emerging market countries need to raise their rates even further to remain attractive. This puts pressure on central banks, freezes credit, and stifles growth. What began as a problem in Japan, it becomes a global pressure current. And at the heart of it all, broken trust. Global investors are starting to ask, if Japan collapsed due to rising interest rates, who will be next? That uncertainty alone already changes capital flows. Funds are starting to reduce their exposure, volatility is increasing, hedge funds are positioning themselves for declines, and any instability becomes a trigger for mass sales. This is how crises escalate, not through logic, but by the speed of fear. The curious thing is that until recently, the United States benefited from the collapse of others. When there was a crisis elsewhere, the dollar strengthened and treasuries became a safe haven. But now, the U.S. is at the center of the risk. With a record deficit, resilient inflation, and a market increasingly sensitive to interest rates, the United States is not prepared to lose its biggest buyer. Japan's exit from U.S. debt markets could be the final push. And here's the key point that few are discussing. If Japan and China are the two largest foreign holders of treasuries, they start selling at the same time. There are not enough institutional buyers to sustain the treasury auctions. The Federal Reserve would have to intervene, which would mean resuming printing. If that happens, confidence in the American currency will be jeopardized. Bitcoin, gold, and real assets are increasingly seen as safe havens. This domino effect, which began with the collapse of Japanese debt, this could trigger a new global realignment. With the West mired in debt and high interest rates, and the East adjusting its bets for a new cycle, financial geopolitics is entering a critical phase. Whoever understands what is behind these movements now, he will be far ahead when the markets start to collapse. And that's why this video wasn't just about Japan, it was about the entire system, and why it's entering the final phase of a historical cycle. In closing, we'll connect the last dots. And to show why understanding this is not enough, we need to act before the collapse becomes irreversible. What is happening now with Japan is not unprecedented. In fact, it's a pattern we've seen before. Economic empires that grow too large and become indebted to the limit, they manipulate the currency and collapse under the weight of their own structure. Rome, Spain, United Kingdom, now Japan and the United States. History always rhymes, but few realize it in time. And even fewer take action before the fall. Most people still think, this time it's different. But the gears are in motion, and the speed at which everything can change is frightening. Japanese debt is becoming the trigger for something much bigger. And it's not a question of if, but when and where it will explode first. The real question is, will you understand now, or after the market has already crashed? because outdated information does not protect, and acting late only guarantees harm. So reflect. Are you positioned in a system that relies on perpetually rolling over debt? Is your wealth tied up in assets that thrive on low interest rates and money printing? You're betting that everything will continue as it always has, or is it preparing for the collapse of the current model? Anyone who ignores these signs is betting against mathematics and against history, and history never loses. Understanding all of this is just the beginning, but watching isn't enough. We need to act. Take a stand. Review your exposure. Seek real protection. And above all, keep studying what's coming next. If you found this content helpful, subscribe to the channel, turn on notifications, and like the video. The next episode will reveal how Japan's collapse is accelerating the end of the dollar as the dominant currency, and why the next crisis won't just be financial, it will be systemic.